How to lower income taxes using real estate in 90 seconds or less. I'm Christopher Small, by the way. I'm a Big Bird Accounting. I'm a lawyer, and my goal is to create the best bookkeeping company in the world. Okay, so if you need books, call us. 90 seconds or less is probably not going to happen, but I'm going to do it very, very quickly and very, very succinctly in a way that you're going to be able to understand. First things first, it's important to know that there are two types of real estate income that you can create. There is active real estate income and there is passive real estate income. Whether or not income is active or passive depends on the amount of time that you spend in the real estate world. At tax time, depending on whether your income is active or passive, depends on where you can use the write-offs associated with your real estate on your income taxes. Active income or active expenses related to real estate you can use to reduce your income across the board, W-2 income in particular, which is what everybody's kind of trying to do. If you have passive real estate losses or real estate expenses, you can only offset those against passive real estate income. Unless, by the way, there's one exception, which is if you earn a certain amount of money, if you're below a certain amount of money, then you can apply some of your passive losses to your active income. If you want to know what that is, just Google it. Long-term rental income. Okay, so if you have a long-term renter, like over 30 days, usually it's like a year, right? You have a year lease for somebody, is pretty much always passive. The only time it is not passive is if you are qualified as a real estate professional. And I'm not going to talk a lot about what it takes to become a real estate professional, but just know this. If you have a regular job, you cannot be a real estate professional, okay? Pretty much. Unless you're in real estate, as that probably makes sense. So if you have a regular job, you cannot be a real estate professional. Pretty much all of your long-term rental losses, depreciation, maintenance, property taxes, insurance, you're only going to be able to offset those against your passive income, which is sort of the rent that you get from your long-term rental. So for example, if you have a long-term rental that generates $6,000 in income, and you have expenses, depreciation, property taxes, maintenance that is over $6,000, you are not going to be able to apply the difference. Let's say it's $7,000 in losses. You're not going to be able to apply that extra $1,000 to your W-2 income. What's going to happen is those losses are going to carry forward to the next year. And if you have extra passive income, you can use that to offset that extra passive income, but you cannot apply it to your W-2 income. Make sense? Perfect. Now, when it comes to short-term rentals, there's sort of a couple of different things that are going on. Short-term rentals, for the most part, are taxed just like long-term rentals as passive income unless you are deemed to materially participate in the operation of the rental. Now, because we are dealing with the law, the IRS has defined what materially participate means. If you meet the definition, there are 7 different ways that you can materially participate, and I'm going to do quotation marks every time, okay, just because they're fun to do. If you materially participate in your short-term rental, then you can apply your short-term rental losses to your active income, to your W-2 income. These are the different things that you can do to materially participate in your short-term rental. You only have to do one of these 7. But you're going to see they're not super easy to meet. Number 1 is have 500 plus hours of work on your short-term rentals. 500 plus hours. That's a lot. Number 2, you are doing all of the work on the property. Okay, you're doing all the cleaning, you're doing all the maintenance, you're doing the renting, you're doing everything that's associated with the property. Number 3, you do at least 100 hours of work on the property and no one else is working more than you. All right, this gets tricky when you're talking about cleaners and when you're talking about other things, right? If you're doing a short-term rental, they're going to be putting in quite a bit of work. You are going to have to match that work. Significant participation activities of 500 plus hours is number 4. To be honest with you, I'm not sure what significant participation means, but I think that deals with, I'm not sure what that is, by the way. Just Google significant participation. It's not the one that you're going to qualify for. 500 plus hours, if you just get regular 500 plus hours, then you're good to go. Number 5 is meeting the material participation test in any of 5 of the last 10 years. So if you have not participated materially this year, but you have in 5 of the last 10 years, you still qualify. They want to recognize if you've been doing a lot of work in the past, you get to carry that forward, essentially. Number 6 is personal service activity with material participation in that activity 3 years in the past ever. Personal service activity refers to like hotel type of services, concierge services, room service, towel service, like daily cleaning. These are what we're talking about when it comes to personal service activity, which most short-term rentals don't do because A, it's not economically feasible, and B, that's not really what people want in short-term rentals. And number 7 is the totality of the circumstances shows participation on a regular, continuous, and substantial basis during the year. You might have that one. You might be able to fly by with that one. That's sort of the most vague description. But remember, if the IRS comes calling, you're going to have to prove that to them. This video is not about showing you how to beat the system. It is arming you with knowledge so that you can use that knowledge in the way that you want. If you are extremely risky, I guess, if you have high risk tolerance, then you may just pick one of these and be like, I'm going to give it a run. If you are low, then you're going to make sure that you definitely meet one of these tests so you can apply these losses to your W-2 income. So using the same example from above, you have a 6-term, $6,000 in short-term revenue, and you have materially participated in that short-term rental, and you have $7,000 of losses, depreciation, not of expenses, deductions, depreciation, maintenance, property tax, insurance, things like that. And you're going to be able to take that extra $1,000 and reduce your W-2 income by that amount, which is pretty cool. But the IRS also knows it's pretty cool. And that's why they are making it harder for you to apply those losses to your active income. This is important, by the way, because if you can materially participate and create a situation where you can take your short-term rental losses and apply them to your active income, you can do something called cost segregation, which ramps up the depreciation on your property and allows you to reduce your income by even more. I'm not going to get in the weeds on that, but just know if you can qualify as someone that can apply your real estate deductions, your real estate expenses to your active income, there are things that you can do that can really ramp that up. Hopefully you have a pretty good understanding of what it takes to use real estate to reduce your income taxes. You know enough now to be dangerous. Get out there, do some extra research. Listen, work with your bookkeeper. Call us for that. Work with your accountant to do your taxes, tax prep and filing. They're not going to be able to help you with this stuff because it's going to be too late. So call us, subscribe if you want more stuff, and that's it. See ya.